let me just start with the conclusion and then go back. And these are my informed predictions, okay? We're not going to have a VAT. We're not ever going to have a VAT. We're not going to have a border adjustment. We're not, and the border adjustment and the cash flow tax don't have to go together. Those are kind of a funny little combination that these guys cooked up. We're not going to have a cash flow tax either, because we're pretty close to one already, and we're already giving those kind of bennies to the sets of taxpayers that we want to give them to. We're not going to have dividend integration. What are we going to have? Okay, the driver in this whole mess was this, and you heard the advertisement for it, that we somehow need a corporate rate reduction. Now, I don't think we do, but we're not here to argue that. That's the driver. It's not going to be as much as advertised. You can't believe any of the numbers that you see in the plans of the rate's going to be 15% or what, but you can believe the relationships, okay? So we're not going to 10% on capital gains, anybody, which is a very interesting point in and of itself. My bet on the corporate rate is something like 29%, which is not enough to make multinationals happy. We are going to get a territorial system. Now, bear in mind that, as Steve Shea says, we already have a do-it-yourself territorial system. And so the territorial system is going to come with clawbacks, which is not what the folks who are running around, have been running around for the last 10 years asking for one want to hear. We are going to have a repatriation holiday because we're so anxious to, reward accounting abuses. We are going to have a net interest deduction disallowance, and that's the sleeper here, okay? That's a thing that gets scored as a revenue raiser, and it's blessed by economists, so you can say, look, they blessed it. And there's a lot of people who don't need to be deducting interest, and that thing is going to happen. Then the other thing you're going to have is you are going to have some rate reduction for individuals and partnerships, because partnerships are going to want their cut, okay? And because a lot of businesses organize as partnerships, and you can't have your congressman going back to their districts and saying, well, I voted for General Electric to pay a whole lot less tax than they already do, and isn't that wonderful? You do have to promise individuals something, and that gets to be very messy because, without going into individual, the numbers are very big, but individual taxes in a lot of cases are pretty low, so it's hard to lower them. Now let us go back to some of this stuff that I said and talk a little about why we're not going to have a VAT and the importance or lack of importance of these budget rules. We have, well, in Europe is a completely different place. It's not really, it's not, even if you took Europe as one piece, as the EU as a whole, you're not talking a peer system. They don't have the reserve currency. They are depending on us for a lot of stuff that does in fact prop up their lifestyle. And we don't have to conform to them. Now, yes, if I'm doing cross-border trade where I'm importing something from Italy, maybe that's nice to conform, but you don't have to do it. As a matter of fact, the people who are doing cross-border trade with Italy, you know what they're upset about? They're upset about state tax nexus. Why can't I have a warehouse in New Jersey, and why is New York State bothering me for taxes? So yeah, we don't have to be in step with them. We are not going to have a VAT, and VAT is not going so well for them at this moment either. And one of the things, two things killed that House blueprint border adjustable tax. Thing one was that we're too far down the rabbit hole importing stuff to switch the boat around. We're not going to become mercantilist Germany and become an exporter. And that's another thing about Europe. Those are small open economies. Their companies grow only by exporting, And they are pretty explicit. Those companies, they don't pay tax on their foreign income. They don't pay a whole lot of tax to their home countries, period. Okay? And look, we could have that deal, but, you're going to have to explain that, to the voters. I'm losing my train of thought here. I was on little open economies. I was on VAT. Well, let me just. Yeah, VAT is the other thing that killed that border adjustable tax, outside of the fact that Walmart didn't want it, is you would have had to set up the entire VAT mechanism to collect the import side of that without having whatever advantages you guys are ascribing to a VAT. And that mechanism is very intrusive, and it depends on businesses to be part of the collection process, and that is not something Americans would ever put up with. I mean, we have, people don't realize it, but when you have the reserve currency, when you don't have to tax for revenue, we have light touch taxation here. Okay, we don't, when we're chasing those people with those foreign bank accounts, we don't do everything we could do to tax people, and we don't do it because A, we don't have to, and B, it would not go over well politically. And a lot of decisions that have been made for the European public were not democratically made. They didn't vote for a VAT. We also have an economy that is 70% consumption. We have an individual tax that functions as, in most cases, except for very, very well-off people, it is a consumed income tax already. We have a whole state sales tax apparatus. You cannot load a VAT on top of that. Okay, that's enough of that. Let's see. Now, when we talk about we don't tax for revenue, the tax system is kind of a giant behavioral device. We're taxing, as the central bankers figured out in the 20s, we're taxing to get people to hold the currency, we're taxing to price things, we're taxing to subsidize certain behaviors, we're taxing to, we don't really redistribute, but we like to pretend that we do. But we don't, it's not true that this number over here, and we're even talking phony baloney government accounting, okay? Because, we know that all these numbers are they're just numbers, and they're not even the complete numbers. I mean, I did a speech the other day where I talked about. Is this thing on? Is it on?
Yeah, just keep it close to you.
Okay, where I talked about all the arms spending we don't, and military spending that we don't even catalog. It's not true that we can't spend and we can't do a big tax cut. I'm going to get into in a second here, which is what Ray was talking about, the constraints that Congress has put on itself. That's what we're talking about. When these people talk about windows, and I love it that we're doing this in a windowless room, when these people talk about budget windows and reconciliation and stuff like that, they are talking about a bunch of self-imposed constraints. Now, okay, why is that important? Because let's get back to our centerpiece. It is a corporate rate cut. That is very, in terms of the bean counting these folks are doing, that's very expensive, okay? Because the corporate income tax is a big subsidy delivery mechanism. It is about 3 parts tax and 1 part subsidy. You cannot cut the headline rate, and the headline rate matters to a whole lot of people, even though, as these folks acknowledged, the very companies, the 6 or so companies that are lobbying for what we're talking about here, ain't paying the headline rate, ain't paying anything like it. They're just got their undies in a bunch because, well, we didn't pay any taxes in Europe and we didn't pay any taxes in Japan, and you're telling us we have to pay residual tax if we dividend that to the United States. Well, gee whiz, But in order to, and this is what the camp draft is about, okay, in the larger sense. Everybody, this is your big takeaway, okay, go back to your office and start reading that thing. Start reading both versions. There's a sort of a 2011 through 2013 version. There's a 2014 version. Read that thing, okay? It is now the default. It is priced. It is drafted up. It is ready to go. You have a Congress that's in a hurry to do this. They will be grabbing things out of it. There are all kinds of things in there. You got REITs. There's a whole bunch of REIT provisions in there. You got partnerships. There's a mandatory 754 election in there. There's all kinds of interesting surprises in there, and you need to be looking through that
Cruise
thing.
ships.
What?
Cruise ships.
Cruise ships, yes. That's an important industry to the United States. There's all kinds of interesting surprises in there that you need to know about. But getting back to the corporate rate cut, you couldn't stay within your budget constraints and cut that corporate rate without taking down all of the subsidies that are in the corporate income tax, and that's the accelerated depreciation, whatever we call it this week, the manufacturing deduction, LIFO, all that stuff. You had to scrape all that stuff out of there. You still couldn't buy the rate down low enough. Then you had to go scraping stuff out of the individual side. How many? Nothing left. 1 minute left. Oh, boo-hoo. But yeah. What, two? Two, let's see. What do we, okay, do I need repatriation? Do I need, actually, I am almost done. Okay. Yeah, repatriation holiday, I mean, I'm just going to end with a pet peeve about this here, and that is, but yeah, and the other thing about, on the spending point, to sort of two more sentences, the other thing about the spending point is, some of these Republican plans were devised as plans to affirmatively spend, to basically spend $1 trillion over 10 years to buy the corporate rate down. They were not designed to be revenue neutral, but you do have prominent Republicans like the Speaker of the House, like the Senate Majority Leader, who are deficit fusspots, and so that is going to have a big control on this, and so when I get back to the accounting abuse that is the repatriation holiday, because you're supposed to be booking a DTL for this stuff if you don't have any use for it. And by the way, none of this cash is offshore. There's like one big company that keeps some of their money in euros. The rest of them, they're dollar-based companies. It's in bank accounts in the United States. There's no bringing it back and reinvesting it that we're talking about here. But that thing is booked because it would be a deemed repatriation, and you can do that at whatever rate you want. Because it's a deemed repatriation, it is booked as a revenue gain. So getting back to, we got the constraints, and because of the constraints and because of the desire to buy the corporate rate down, you're going to see this net interest deduction disallowance. You'll get an out for small businesses. You might get an out for banks, even though you don't need one. You will see this repatriation holiday because it can be booked as a fill-up. You'll see a certain amount of clawback on territorial. One more sentence, clawback on territorial. That is serious business. Because here is what happened with the camp draft, and there's a set of clawbacks in the earlier camp draft, right? The 3 sets of clawbacks, which we can talk about later if you want. When the camp drafters did this, and now that people are looking at this, they're looking at a set of rate reductions and a territorial, but without going to some other exotic form of tax, they're scared. Okay, when you say to these guys, you're territorial, that is full capital import neutrality. That means if you go to zero outside the United States, you get to keep zero. That is scary. That is base erosion city. So you are going to see clawbacks, and you need to study the clawbacks that are in that old camp draft because there are folks on Capitol Hill studying them now. Thank you.